Welcome to Talk Tickers. Today, we're breaking down the Q2 2025 earnings call from Ryman Hospitality Properties, ticker RHP. And let me tell you, their stock went on an absolute roller coaster after this report. It plunged, then recovered, all on massive volume. So what was the real story behind the numbers?
So let's dive right into this. On August 5th, the market just could not make up its mind about Ryman. The stock dropped nearly 2% during the day, which is a pretty decent dip, only to completely reverse course and close up in the green. And get this, all of this happened on trading volume that was 2.5 times the daily average. That's a clear sign of a big debate happening among investors.
You know, this kind of wild whipsaw action tells you the market was seriously struggling to digest a very mixed report. So let's unpack what drove that initial uncertainty and, what led to that eventual recovery. Let's find the real signal in all that noise.
Okay, so the crucial point is that on the surface, this quarter sent completely contradictory signals. It was a classic good news, bad news situation that left a lot of people scratching their heads, not sure which way to turn.
And these results show a real split decision. On one hand, they missed on the standard accounting profit, that's your GAAP EPS. But on the other hand, they beat on adjusted funds from operations, or AFFO. Now, for a real estate company like Ryman, AFFO is arguably way more important, because it measures the actual cash being generated. And to top it all off, they absolutely crushed revenue expectations, posting a company record.
So right out of the gate, investors were forced to ask, is the real story the accounting miss, or is it the strong cash flow? This contradiction right here was the very first sign of just how complex this quarter really was.
And believe me, the contradictions didn't stop there. When you look inside that huge revenue number, you see the massive beat wasn't driven by their core hotel business. That was actually down a little bit. No, the hero of the quarter was their much smaller entertainment division, which just exploded by over 50% and delivered record performance. Wild, right?
So, what's causing this split personality in the numbers? Well, it really boils down to this conflict between a powerful short-term headwind that's spooking the market and two major long-term tailwinds that management is absolutely banking on.
So the primary headwind is right in their own backyard. Nashville has seen this flood of new hotel rooms open up, and it's creating intense pricing pressure on rates for individual travelers. This is directly hitting their crown jewel, the Gaylord Oprylandand. Management's calling it a temporary side effect, but make no mistake, it's a real drag right now.
But pushing back hard against that is the first major tailwind, the strategic acquisition of the JW Marriott Desert Ridge in Phoenix. I mean, this is a classic Ryman move, buying a massive, high-end hotel that caters to their core group meetings business. It helps them diversify away from Nashville and really strengthens their competitive moat.
And management could not have been clearer about how important this deal is. CEO Colin Reads said they've been trying to buy this specific property for nearly a decade. So this isn't just some random purchase. This is a cornerstone of their entire long-term strategy.
And the second really powerful tailwind is that booming entertainment segment. Thanks to all these investments in music festivals and live events, this division is definitely not just a side project anymore. It is quickly becoming a significant, high-growth contributor to the bottom line, proving that consumer demand for live experiences is just incredibly strong.
So, how does this all fit into management's long-term playbook? Well, this is where the story really shifts from a confusing present to a much clearer future, and it's almost certainly what gave investors that boost of confidence by the end of the day.
Management's updated guidance for the rest of 2025 just perfectly reflects this two-sided story. See, they raised their core profit projection, EBITDA, thanks to that new acquisition. But, and this is a big but, they lowered the all-important AFFO per share, blaming the financing costs for that deal and that persistent weakness back in Nashville.
And right here, this is the key takeaway for anyone looking at the long term. Despite all the near-term caution, the pipeline for their core group business, the real engine of the company, looks incredibly strong. Advanced bookings for 2026 are already up 9% from this time last year, and 2027 is up 10%. This is the long-term story that, for many investors, outweighed the short-term pain.
So, what does this all mean for the next quarter and beyond? All right, let's put it all together and give you our final take.
Okay, so we're assigning a market perform rating. The powerful long-term thesis, the one built on group bookings and the Desert Ridge deal, it's fully intact, but it's balanced by some very real short-term pressures from that Nashville supply glut and renovation disruptions at other properties. Those things need to resolve before the stock can really break out.
Here's how we see the next few months playing out. Q3 results will likely reflect the headwinds that management was very clear about, which will probably keep the stock trading sideways for a bit. The key catalyst you want to watch for, the thing that could make it move higher, is any sign of stabilization in Nashville's individual traveler rates, and of course, positive news from the integration of that new Desert Ridge property.
And this leaves us with one final thought as we look toward the next earnings call. It seems like the market has priced in these near-term challenges. So the big question is it underestimating the power of Ryman's long-term group business and that booming entertainment engine to pull the company through this turbulence faster than anyone expects?
This is not financial advice.